This video was made for the members of the Motor Industry Retirement Funds and with the help of Axiomatic. Stocks on the JSE has fallen a lot since the beginning of the year, down 27% to end of March. Local property shares have imploded in value, and even the bond market has given you a negative 9% return. The rand has weakened significantly against the US dollar. This is all very worrying, especially when you look at your retirement savings. Unfortunately, nobody has a crystal ball to predict the future, but we can learn a few important lessons from the past. Here is all the proof that you will ever need to avoid panic selling and withdrawing investments at the bottom of a market crash. In this table, we show all of the market crashes that have happened in just the last 90 years or so. Firstly, you will notice that market crashes actually happen quite often. The table ranks every crash, starting with the most severe one at the top, being the 1929 crash and the onset of the Great Depression. Markets fell an astounding 86%. The column entitled Trough shows the day on which the market hit its lowest point. The next three columns show the growth in the market over 1 year, 3 years, and 5 years measured from this low point. In every single case where the market has crashed, it recovered. In all cases, the market increased in value many times over what the level of the market was before the crash. On average, the market grew 52%, 88%, and 132% after previous crashes in the 1, 3, and 5 years after the crash. Here we show the US stock market between the 12th of March and the 26th of March. The 2-week period during which the market was in extreme turmoil. We show by how much the market went down on some days in the red bars, and by how much the market went up on other days in the blue bars. The height of the panic occurred on the 16th of March, when the market fell an astounding 12% in just one day, one of the biggest single-day falls in history. Investors who panicked after the 16th and who withdrew from their portfolios in the following days missed out on the days during which the market recovered. In the 3 days between the 24th and the 26th of March, the market was up significantly. In fact, it was the highest 3-day return in the market since the crash in 1929. An investor who had cashed his investments after the 16th would have locked in his losses and would have missed the subsequent recovery. This shows again that especially when saving for your retirement, we should invest for the long term and not be too concerned when markets react volatilely in a short period. They often do. Because we cannot time when the market will go up and down, an investor who moved to cash after the 16th of March would have missed out on the recovery. Just because your fund has lost some of its value doesn't mean that you've lost that money forever. We just have to ride through the ups and downs. Thank you for watching. This video was brought to you by Anchor Capital.